Hello, class. I hope you all are doing great, keeping yourself sanitized and keeping yourself home. So it's really good to see you. So let's get started with our today's session. So basically, I've prepared this session for you. Today, we are likely to cover some areas of the business studies for your IGCSE. So today's topic is the sources of finance. From the reference book 921 IGCSE, chapter 25, page 210. So what are we likely to cover in this session? So, what do we learn? This part of the specification from the sources of finance is 3.1, the learning outcome 3.1, business finance sources. We're going to cover the need of finance, either it's a short-term need or a long-term need. Why do the business need the money? Maybe for a startup or maybe for expansion. We're likely to find the potential differences between internal sources and the external sources. Internal sources of finance, such as personal savings, retained profit, selling of assets. External sources of finance, such as overdraft and trade payables, loan capital, share capital, issue of share or market flotation for public limited companies, venture capital, crowdfunding. So, why do businesses need finance? So, why do they need money? Well, as you know, it's an essential. It is an essential source of. It is an essential resource. Money is an essential resource to start up a business. So basically, when you're talking about the need of money, I don't think I need to explain a lot regarding this. But still, a business may want to start. So when we are starting a business, as you already know that we are actually investing. Into two parts. We are actually putting the money when you're starting a business. We are actually putting the money in two particular expenditures, right? So one is the capital expenditure, and the other is revenue expenditure. So the capital expenditure is where you're spending your money to buy fixed assets such as premises, land, vehicles, then machineries, equipment. When you're investing this money, it is basically for a long term. So capital expenditure is spending on items that may be used over and over again, and this is going to be there for a long time, right? But the revenue expenditure refers to payments for goods and services that have either been consumed or will be very soon. So it's kind of the day-to-day expenditure for the business. So the business may want to open itself into new markets, in a new country, or they might want to widen their geographical territory, right? For that reason, the business may need finance. The business may want to start a new advertising campaign, and maybe for financing that advertising campaign, they will need finance, right? Business needs money for a lot of reasons, right? So we are going to find out what are the sources of these finance and where this money comes from, right? So basically, as we already know, that there are two sources of finance. One is internal source of finance, and the other is the external source of finance. So when you talk about the internal source of finance, this is the money that the business generates for itself. So when you're talking of internal sources of finance, this is the money that the business generates for itself. So this actually comes from the trading of the business itself, maybe from the day-to-day cash it has got. This can be from different sources that the business has got for itself, right? Different kind of savings or things that business have got for itself. And when you're talking about the external sources of finance, it actually comes from individuals or organizations who do not trade directly with the business. It's actually mainly the third-party organization, sometimes. such as the banks, the investors, the government. Yeah, so these are the sources of finance we have for the business. So in general, but let's look into them and let's find out what are they actually like, what they look like, from a widening view. So what we have here is the internal sources of finance. So we do have three kind of major internal sources of finance available for a business. So when you're talking of internal sources of finance as such, the first thing is the owner's capital, right? So owners are, like owners or entrepreneurs are those people who are actually investing in the business. So they often provide with their own savings, or they start up a business, from their own money. So when you look into the owner's capital, it's actually the money provided by the owner himself or herself. Yeah. So it is an internal, as I've told you earlier, that internal finance is the money generated by the business or the current owners. In most cases, actually, a business cannot start unless an owner provides capital of its own, right? So providing capital is a part of the risk taken by the entrepreneurs, yeah, when starting up the business. So that's where we actually look into, right? So owners provide capital from their own personal resources. A common source of this personal resource is actually like personal savings, right? Some entrepreneurs actually save for years and years. They deliberately save for years and years, right? And they when starting the business, when it's starting a business of their own, they actually put all their savings into that business, right? Some entrepreneurs are actually have been working for an employer or some other organization for too long. They have been employees for too long, and they do have savings from that job, right? That they want to invest and becomes an employer now, or maybe start up their own business. So that's where actually the money comes from, right, for them. So there's another source of finance. We know another internal source of finance. We know it as the retained profit. So retained profit is the profit after tax that is put back into the business and not returned to the owner. So this is the amount of money the business is actually saving itself. This is the part of the profit that the business gets to keep for itself rather than giving it to the owners or the entrepreneur, right, to be taken away. So it is one of the most important sources of finance for a business. A lot of business funding comes from retained profit. It is the cheapest source of finance with no financial charges such as interest or any kind of administration cost. Yeah. However, there is always an opportunity cost involved when it comes to retained profit. If retained profit is used by the business, it cannot be returned to the owners. For a small business, this might mean that the owner and their families have to have less money to fund their lifestyle. For limited companies, it means that shareholders receive lower dividends. In case of public limited company, this may lead to a conflict between the shareholders, right? Retained profit is a flexible source of finance. It does not have to be used immediately. It can be collected gradually by the business and retained in the bank account where it will earn interest. So retained profit is a kind of saving which earns itself, right? If a business does not make a profit, retained profit is not possible as a source of finance again, right? Then comes the sale of assets, right? Businesses, often like established businesses, they do have unwanted assets to raise finance. Though it's not appropriate in the context of Bangladesh to sell your asset, but well, in some countries, yes, especially as from the context of UK, it's true that business can sell its assets, right? So, for an example, machinery, obsolete stock, land and buildings that are no longer required could be sold off, and business could actually get some cash out of it, right? Which they can use, to fund their regular expenditures, or either they can buy new assets which might be necessary or which might be needed by them, right? So as I've told you earlier, that using own cash to start a business, it is the cheapest source of finance, and since it carries no obligation to pay an interest, it does not, when you're using your own money to fund the business, you have your total control. Yeah, you don't have to share the control with any other party or any kind of other organization, right? Uh, it is kind of more flexible, as no authorization is needed. You don't have to get any kind of approval to use it. It can add the like the finance necessary for something like for a new venture or something. Yeah. And like sometimes you do get actually kind of various kind of tax rebate on that. So when you're actually using your internal, it is any of these internal sources of finance, there are a common set of advantages that the business gets. The first advantage is that the capital is available immediately, so there is no time delay between identifying a need for finance and obtaining it, right? It is actually cheap. Internal source of finance is cheaper than other options or external sources of finance, as there are no interest payments, which means that cost will be lower and profit is higher, right? And in most cases, there are no administration costs as well. There are no added administration costs as well. So that's an advantage of the internal source of finance. Lastly, there is no need to involve third parties, so you do have total control of your own business. That's one big advantage of the internal source of finance. Yeah. However, there are some disadvantages of internal sources of finance, such as the capital available is limited. Yeah. So the internal finance can be limited. A business may not have sufficiently profitable to use retained profit. If you think of small businesses, they may not have retained profit available to use, right? On the other hand, sometimes the current owners or the entrepreneur does not have any personal resource to contribute to his or her business, right? That can be the trouble. On the other hand, the problem with this is with the internal source of finances, it cannot help the business with any kind of tax rebate. Rebate means reduction, so it does not reduce the taxes for the business. So when you're using internal source of finance, it cannot be subtracted from business profits to reduce the tax owed, right? So there's no tax, you're not actually getting any kind of tax reduction. Yeah. So rather, if you'd be using external finances such as a bank loan or any kind of leasing, that could help the business, to deduct some taxes and reduce the tax cost for the business. It is actually inflexible, as options available are limited, right? So when you're talking of internal finance, it can be actually inflexible compared to external sources of finance. There's a wide variety of funding methods and options when you're looking into the external sources, but we got only a few when it comes to internal sources of finance. Yeah. Lastly, opportunity costs may arise. There is always an opportunity cost when you're talking about internal sources of finance, right? For example, if you think of you got £1,000, with these £1,000, either you can invest in marketing campaign, in a new marketing campaign, or you can invest it to buy, buy new machines or equipment. If you're investing it in buying like new equipments, yeah, the new marketing campaign is likely to be your opportunity cost. And if you're choosing the marketing campaign, then buying new equipment is likely to be your opportunity cost. So there's always an opportunity cost. And the other problem with internal sources such as retained profit, it takes years and years for some businesses, actually it takes years and years to save money, even for the owner. But once you spent it, you don't have it available immediately again, if the business needs it, due to any kind of emergencies or contingencies. Yeah. So that's all we have for the internal sources of finance. Now let's talk about the short-term and long-term finance. Right, as we have discussed this earlier regarding the capital expenditure and the revenue expenditure. So, revenue expenditure refers to working capital. Revenue expenditure refers to, like the day-to-day expenditure of the business, right? So, revenue expenditures, like the amount of money we spent on a day-to-day basis, or we actually like the money that we need for a year or any criteria between 12 months is what we call to be a short-term finance. So it's mostly the revenue expenditure. The short-term finances are needed to cover the day-to-day running of the business. It's paid back in short period of time, and so it's actually less risky for the lender. And when you talk about long-term finance, this is the money actually we spent we spent on capital expenditure, right? So this is the money we spent for a long time, such as buying vehicles, premises, land, things like that, right? It tends to be spent on large projects which will pay back over a longer period of time. Sometimes it's actually more risky for the lenders. And like mortgage, debenture, these are one of the long-term finances we have, and we're going to have a further discussion within a few minutes in the with the upcoming slides, right, regarding this. So let's move on. So the main sources of long-term finances are mortgages, bank loans, share issues or share capital, and debentures. So external sources of finance. External sources of finance actually. It is actually like the few businesses can rely entirely on internal sources of finance to fund its business activities. Yeah. So as the business grows and maybe like as the business wants to expand, initially external finance, which is the finance from sources outside the business, yeah, is needed. So basically, once the business faces all the startup uncertainties, or maybe like once the business actually like comes up to a stage, to establish itself, it actually needs to depend in external sources of finance. So basically some common sources, external sources of finances are family and friends. We get a set of funding from the banks. There comes in different kind of methods, right? We'll be discussing the methods of and sources of finance from bank later on the slide. We get money from the external sources of finance also include the venture capitalists, trade credit, grants, crowdfunding. We are going to discuss all this on the later part of the slide. So let's talk a little on the friends and family and friends. Remember, getting money from, especially when you're starting up the business, getting money from the family and friends, or family or friends, can be like is a very common source of finance. Yeah. So particularly for a small business, mostly the family members are close or friends are close, so they actually gain money from them, right? They get the money from them to start, or maybe like to support the business. So this may be cheap source of finance if the money is a loan and interest charges on this money can be low, or maybe sometimes there's no interest in money from a friend or a family, right? So in some cases this might be gifted to the entrepreneur, maybe like your dad gifting you money to start up a business, right? That can be one thing, right? So another possible advantage of this finance is from friends and family is that they may not want to share the ownership of the business. Yeah, it might be like you got the money from your friend when you're starting the business, but they are not interfering in the business, right? They just believe that you're likely to pay them back. You're going likely to pay them back this money whenever you have it, or business is making a profit, right? However, like serious problems could arise if this money is not paid back, or you cannot repay the money, because this could lead to loss of friendship, or maybe could lead to breakdown of family relationship. So it's very important from personal space to think of this money and actually think of it over and over again, right? So let's talk about finances available from a bank. As I've told you earlier, that what are the finances we do have available from the bank. So The finances that we have from a bank is like bank overdraft, bank loans. There are types of bank loans, asset financing, which we asset finance, or which we also call to be leasing. We have mortgages available from the loan as well, right? So let's talk about the difference between a bank overdraft and bank loan. I mean, like, what is a bank overdraft and bank loans? I'm going to come to the loan section later. So bank overdraft, when you're talking about an overdraft, when you're looking forward to an overdraft, this is an important source of finance for large number of businesses, right? A bank overdraft means that a business can spend more money than it has in its account. For an example, you have in your bank account, you might have £10,000. Yeah, but you're giving me a check of £12,000 to withdraw, right? When I'll withdraw that amount, when I'll withdraw that amount, I'm actually withdrawing £2,000 extra than what you have in your bank account. That's £2,000 is going to be your overdraft, right? So, in other words, like they go overdrawn. The bank and the business will agree on an overdraft limit. Basically, they actually agree on a limit, and like interest is only charged when the account is overdrawn. So the bank will agree with you to provide an overdraft, but till a limit, certain limit, right? This amount, which actually like this amount, the amount by which a business goes overdrawn depends on its on the time of need and the type of need you have, right? What type of need do you have? Are you likely to pay salaries to your employees, or maybe purchase some raw materials but remember, overdraft is a short-term finance, right? And this is only likely to be used for supporting and funding short-term sources of finances, right? However, a bank has the legal right to call in the money owed at any point in time, right? This will happen if the bank suspects that your business is actually struggling and like you are unlikely to pay the money owed, right? This amount of borrowing may vary on daily basis. Technically, this is repayable by you to the bank whenever it's needed, right? And on the other hand, this as overdraft, you're not actually like putting any kind of collateral property, right, to the bank, or it is actually risky for the bank to provide you with such kind of loan. So therefore, the interest charged on overdraft for bank overdraft is actually very high, right? So two things you should consider. Always remember that overdraft is a short-term loan. Yeah, it needs to be paid whenever the bank calls. And on the other hand, you can never use this money to buy to spend it on a capital expenditure, right? Or things that you're going to use for too long, or if the amount is too big, you cannot use this money, right? And secondly, on the other hand, the interest rate charged on a bank overdraft is very high, so it's kind of an expensive source of finance for the business. Now, the bank loan, if you think of bank loan, is basically when you talk about a bank loan. Bank loans are probably the most common type of loan, right? They may be unsecured. So bank loans are often unsecured, right? Which means that the lender has no protection if the borrower fails to repay the money owed, right? It is not always necessary to, put a collateral property, right, when you're actually taking a bank loan, right? In general sense, we think, whenever there's a bank loan, there is always a collateral property involved. It's not always a collateral property involved, right? Because if collateral property is involved, that's called a mortgage or a secured loan rather than a regular bank loan, right? So, however, the use of these unsecured bank loans has probably diminished in recent years due to, the high risk that the bank carries. So, mainly, in recent years, the bank carries a higher risk, and bank finds themselves at a higher risk. So, they have reduced, providing the bank loan. Unsecured loans, yeah. So, when you look into this bank loan, right, the amount is fixed, and you got to pay it in installments for a fixed period of time. So for an entrepreneur, it's a very good approach, yeah, because they actually can plan with their cash flow, right? They can plan the business, and like if the expenditures are fixed, they can plan accordingly with their revenue and expenditures. Regular fixed repayments actually provides you that facility, right? Interest on loan tends to be, well, lower than the overdraft, but remember, as it is an unsecured loan, again, other sources of finance may be cheaper than a bank loan, right? Normally, it's a fixed term loan and will be for a greater amount than an overdraft. So bank is likely to provide you with more money than an overdraft, right? Then come mortgages. Mortgages are actually secured loan, whereas the bank loans are unsecured, but mortgages are secured loans, right? This is where the borrower has to provide assets as collateral to support the loan. So you need to provide the bank or any party providing you with mortgage, yeah, with a collateral property. Collateral property are those assets, basically which is actually like when you talk about a collateral property, it is an asset which is put to secure, make the loan more secured, yeah. So this is actually like, if you, for example, if you're borrowing £10,000 from a bank, and you have a land which costs you £12,000, yeah, the bank is likely to keep the papers and the of that particular land, claiming the ownership if you cannot repay the bank it's the money that it owes, yeah. So the bank is likely to pay you £10,000, keeping the property of £12,000, yeah, and then they're likely to take the asset from you, yeah, or resell it, right, if you cannot pay back the loan. So it makes the entire process secured for the bank. So that's why it's a secured loan, right? Mortgage is actually a long-term loan, and it's typically can be up to for 25 years in some cases, right? They might use this, for large capital equipment. Mortgages are usually cheaper, right? As it's secured, so it's actually cheaper, right? Then we have debentures. Debentures are actually, very long-term loans, right? So when you to think of a debenture, it is a long-term source of finance. Excuse me. Debentures are only available for public limited companies. Usually it is secured against an asset, repayable at the fixed date, just like the mortgage or the bank loan, right? And with a fixed rate of interest. Debentures are actually specialized methods of loan finance. The holder of a debenture is a creditor, someone to whom the business owes the money, yeah, of a company. He's not an owner, remember that. Debenture holders are entitled to a fixed rate of return, right? They get a fixed rate of return. Doesn't matter if the business is making a profit or a loss, right? They are repaid on set dates, and basically it's a for public limited companies use this as a long-term finance. It's a very long-term finance actually. Then comes share capital, right? So any kind of companies you think of, right? If you think of companies, if you think of limited, we do have the share capital available, right? For private limited company, we know that the shares are being kept between friends and family, so therefore they cannot secure a lot of finance and availability. There's not a lot of availability of finances like the public limited company. But as a matter of fact, the public limited company can sell their shares into the stock exchange, and it's a market of the second-hand shares, yeah. So they can actually secure a lot of money, capital. So through the sale of shares. So when you look into this share capital or these method of finance for a public limited company, we are actually looking into the authorized share capital. It is the maximum amount that can be legally raised by a company, right? So when you talk about limited company, share capital is likely to be the most important source of finance. The sale of shares can raise very large amount of money for this. Issued share capital is basically the money raised from the sale of shares. Authorized share capital is the maximum amount shareholders right wants to raise. Share capital is often referred to as the permanent capital for the business. This is because it is not normally redeemed. It is not repaid by the business. Once the share has been sold, once the business sells a share, right, the buyer is entitled to a share in profit of the company, right, as a dividend. Dividends are not always declared. Sometimes business makes a loss and needs to keep the dividend away, right? A shareholder can make capital gain as well, right? So basically, what we look when we are talking about shares, shares are not normally sold back to the company. So the business is actually keeping that part for themselves. So share in the private limited companies are actually transferred privately. Shareholders privately. Shareholders, because they are part of the part owners of the business, are entitled to vote. One vote is allowed for each share owned. Voting takes place annually, and shareholders vote either to re-elect the existing board of directors or replace them. So we do have different kind of shares, right? The company can issue different kind of shares, such as the ordinary share. These are also called equities and are the most common type of share issued, right? They're also the riskiest type of share, since there is no guarantee. There's no guaranteed dividend, right? The size of the dividend depends on how much profit is made and how much the directors decided to retain in the business. All ordinary shareholders have voting rights. When a share is actually first sold, it has nominal value shown on it. It's actually original value of the share. So, along if the business is making, particularly the business is making, money, if its valuation is increasing, so actually the shareholders are gaining, the share prices are rising, so they're gaining on their investment, right? So they're making a capital gain on that as well. So secondly comes the preference shares. Preference shares is basically those shareholders. Preference shares are basically sold, and these are the preference shareholders are those shareholders who receive a fixed rate of return when dividend is declared, right? Preference shares are actually less risky, right? But the preference shareholders, they don't have any voting rights. They get a fixed rate of return, just like debenture holders, right? They're actually getting a fixed rate of return, even if the business is making a profit or not. Preference shareholders are not strictly owners of the company. If the company is sold, their rights to dividends and capital repayments are limited to fixed amount. Some preference shares also allow their holders to receive late payment of dividends that were missed in years when the dividends were not declared. Some are actually redeemable, which means that they can be bought back by the company. Lastly, we have deferred shares. Deferred shares, you don't have it in your book. I've added this just to give you an overlook of the entire share capital that can be gained by the business. Deferred shares are not used often, right? They're usually held by the founder of the company. Deferred shareholders only receive a dividend after the ordinary shareholder have been paid a minimum amount of money, right? Actually, this is kept by the founder of the company or the owners' families, before they run public, so that the business, they have the control of the business, right? Share issues, actually, as we have discussed, this might be a recap of the things that we have discussed already. Two types of limited company, actually, we have a definition of. One is the private limited company, who can sell share only to designated people. And there's a limit of how much capital can be raised, as it belongs to the friends and family. The private limited company actually remains between the friends and family. So the sources of finance is limited as well. The public limited company, basically, which suggests that a public limited company can issue share to public. This means anyone can have shares in the company. Finance raised by a company by selling new shares to the shareholder. Unlike a loan money, does not have to be repaid over a fixed period of time, right? When shareholders sell their shares to another, the company does not raise any additional funding. Remember that, since no new share have been issued, right? So as we have discussed the ordinary shares and preference shares already, ordinary shares are the most common type of share capital. Ordinary shareholders do have the voting rights. Amount of dividend received actually varies based on the profit of the business. Whereas the preference shareholders, they do have fixed return. Doesn't matter if the business is making a profit or a loss. Shareholders actually cannot vote, right? And shareholders receive their dividend before ordinary shareholder capital and before the ordinary shareholders, and lastly receives the dividend is received by the deferred shareholder if any is left, right? So return on investment for capital shareholder or return on capital investment for ordinary shareholders, actually they come in two parts, right? Ordinary shareholders can, have their return as dividends, which is paid as a percentage of the profit and the percentage of share they possess, right? And there can be an increase in the value of each share as the company itself grows. So when there is an increase in the valuation of the company, if the company is adding more fixed assets in its financial statement, right? So there's an increase in the value of the share of the ordinary shareholders. They do have it as a capital gain, right? A shareholder only actually realizes a gain on the increased value of a shareholding when those shares are sold, right? Companies do not have to pay out dividends. There may not be profit available every time the company is not likely to make a profit. So shareholders, ordinary shareholders may miss their dividends, yeah. And there can be there can be a decrease in valuation of assets as well. So they might be losing on their capital investment. So debentures and ordinary shareholders, actually, when you talk about debenture, right? They're the lender. They don't have any debentures, people providing debentures or lenders. They don't have any voting rights, whereas ordinary shareholders do have the voting rights, right? Debenture holders actually people providing the debentures gains and interest. Ordinary shareholder gets the dividend, which is the percentage of profit in their share. Providers of loans are paid out before the ordinary shareholders. Definitely, ordinary shareholders get whatever's remaining as from the profit for the year before the after the costs were deducted, expenses were deducted, but the debenture holders, providers of loan, they actually get the money when expenses is being counted. So their one is in interest, which is being added with the expenses in your income statement. So that's the difference, right? There are other methods of external finance, such as the venture capital, trade credit, and crowdfunding. So we are going to look into the venture capital. Basically, venture capitalists are specialists in the position, and basically they are the people who are interested. There might be people or organizations, it can be an individual or a firm, who are actually interested in highly risky businesses, right? Venture capitalists are specialists in provision of funds for small and medium-sized businesses. Typically, they invest in a business after the initial startup. Means they just want to invest in a business just in the beginning, right? And often prefer technology companies with high growth potential. So normally, venture capitalists do like to invest in businesses with high growth potential, mainly technology, pharmaceuticals, any kind of new businesses and ideas that arrives in the market, right? So they prefer to take a stake in the company, which means that they have some control and are entitled to share in the profit. Venture capitalists raise their funds from individual investors, such as pension funds, insurance companies, and wealthy individuals, right? They're likely to exit means they're likely to invest with the business for 3 to 5 years, right? And they're likely to take their profit and share out of the business within 3 to 5 years. So they're not like they don't invest in a business for a very long term, but rather for a medium period, right? 3 to 5 years, right? Then comes the term trade credit. So trade credit is basically a very common source of finance for business. It is common for business to buy the raw materials, components, fuel, any kind of essential supply, and pay them at a later date. Usually, like business receive a 30 to 90 days payback period, right? They're actually paying for goods and services using trade credit seems to be an interest-free way of raising finance. It is particularly profitable during the during the time of inflation, right? Many companies actually encourage early payment by offering discounts, right? So if you're taking a trade discount, if you're taking a trade credit, your supplier may not give you a cash discount, right? So you might be losing. So the cost might be a little higher for you as you are not gaining the cash discount, right? So trade credit is basically what we know today as the trade payable or the creditor earlier, right? So the money you're getting from the creditor or the trade payables for like not exactly the money when you're buying supplies and paying for them at a later date is what we know as the trade credit. Yeah. Then lastly comes the crowdfunding here. Remember, crowdfunding is a very new concept, right? Crowdfunding is similar to kind of peer-to-peer lending. It's much more like raising your fund. It's raising the fund through internet. So basically, when you're talking about crowdfunding, we are looking forward to things like crowdfunding. So you're looking into an online kind of online source of finance. So crowdfunding is where a large number of individuals, the crowd, actually invest in a business or project on the internet, avoiding the use of the bank, right? So here you actually get the finance from the internet, avoiding the use of the bank. So here actually a crowd of people supports your business for an example, you have a business and you're uploading the business plan on the crowdfunding site. There are a few sites available. For an example, the sorry, I forgot the name. The Funding Circle. There are like some kind of other organizations such as some other fundraisers as well. I don't remember. I can't recall all the names now. There are something like I think there was one Ulili or something like that, Kickstarter, Tumblebug or something like that as well, right? So there are different sites actually available. Like some of them are from the US, some of them are some Korean sites. So here, like when you're uploading your business plan, you're actually showing your project in the project. So this crowd of people who are interested in your business, they actually fund your business, right? They provide you with the funding, right? So here the banks are excluded and individuals can lend money to others without previous knowledge of them. That means, like the people investing in your business does not know you or does not have any idea about you. However, the fundraisers tend to be business or groups who are actually involved in particular venture, such as putting on production, building a school, or like setting up community project, project works for the community. The lenders or investor will be large numbers of individuals and like who collectively represent the crowd, right? Who individually represent this crowd. Transactions are conducted online, right? So some of these sites actually carry out checks on the fundraisers, but like not all of them. In some cases, the investor who can usually pay as little as £10 towards the venture are offered shares in the business, right? So that's what can be taken. Then we have sources of finance for sole traders and partnership, right? So available the sources of finance we have for the partnership of sole traders could be bank loans, bank overdraft, trade credit, retained profit, or maybe taking on a new partner, or they might be having government grants, right? The government grants can be there as well, right? So we are going to discuss two things. One is the leasing and the government grant, but in the later part of the topic, later part of the slide, right? So that can be one thing. Remember, there is no company, so sole trader actually cannot, or partnership businesses cannot gain, do not have access to share capital or anything as such, right? Then comes debt factoring. Basically, what is debt factoring? What is debt factoring? Debt factoring is when actually business sells its outstanding customer accounts, yeah, those who have not paid their debts to the business, to a debt factoring company. For an example, I might be like, I'm going to get money from Mr. X, yeah. I'm likely to get £10,000 from Mr. X. Now, I need the money immediately, and Mr. X told me that he's likely to pay me in July, right? It's possible that I might have a check from Mr. X suggesting that I'm going to get £10,000, or maybe I do have some sales receipt or something, right, as an evidence that I am going to get the money. So what I'm going to do is, as I need the money immediately, I'm going to sell these evidences, and I'm going to actually sell these evidences, and I'm going to patch this money with somebody else, right? So for an example, I'm going to get this money from Mr. X in July, but as I need the money immediately, yeah, I'm going to give this check to Tahsin, and Tahsin is going to pay me £9,000, right? Because he's paying me immediately, he's keeping £1,000 as his profit, yeah? So what happens? I'm likely to get £10,000 from Mr. X. I'm going to receive the money in July, but I need the money now, which is mid of April, right? So therefore, I'm selling this debt to Tahsin, and Tahsin is likely to pay me £9,000, keeping £1,000 as a profit, because he's paying me immediately, and he's going to receive the cash from Mr. X in July, right? So that's what is debt factoring. So Tahsin is the person who's doing the factor. Tahsin is the factor. So he's actually doing the debt factoring for us, for Mr. X and me, right? So the factoring company pays the business a face value of debts less a charge, such as Tahsin kept 10% of my money as a charge. The debt factoring company actually keeps 15 to 20% sometimes, yeah? But then collects the full amount of money for itself. It is a good way for the business to, keep cash flow running, because you get the cash immediately. But definitely, it's not profitable, because the debt factoring company keeps percentage, yeah, keeps the percentage of the profit. So the then available source of finance could be like the government grant. Some business might qualify for financial support in the form of grant, right? Both central and local government in most countries around the world actually have some range of schemes. A list of grants available can be accessed using the government business finance support finder, right? So grants are usually available to small businesses, providing they meet certain criteria. So if you want to obtain a grant, you have to meet certain criteria. Most grants do not have to be repaid. So this is a significant advantage of this type of external finance, right? Remember, government grant is actually a subsidy to increase supply within the, to support, small farms within an economy, to increase supply times, to reduce inflation and have inflationary control. And it is actually a kind of support from the government for businesses. For example, often a full-scale, full women, entrepreneurship can avail itself a grant in Bangladesh. If you're a women entrepreneur, running a like a business dependent on women and like employing more women, you're likely to get a grant. It might be available for you. A grant might be available for you, right? So you need to meet certain criteria, like to obtain a grant amount or like things like that, right? So this allows firms to select specific for funding option actually, right? And search for grants by business location is actually depends on the business, its location, size, and the type of the business activity. So grant is often protected to protect. Grant is often provided to protect jobs in like in failing or declining industries. It sometimes helps to create jobs and like reduce unemployment. Sometimes it's very supportive for these small businesses. And there are a lot of criteria actually, like whenever someone is provided with a grant, they need to fill up, right? So these things are considered when like government is actually providing a business with grant. Then comes leasing. A lease is actually a contract through which a business acquires the use of resources such as property, machinery, or equipment in return for a regular payment. Yeah. So when you're talking about a lease, it is actually a contract to acquire the use of resources such as property or equipment. It's kind of a long-term rental agreement, right? With the finance, lease is the arrangement is often for 3 years or longer than that, right? At the end of the period, the business is given the option then buying the resource, right? There are some advantage of the leasing, right? No large sum of money is needed to buy or use the equipment. Maintenance and repair costs are paid by the leasing company often. It can, like hire companies can offer the most up-to-date equipment. So you do have access to, like up-to-date equipment. Leasing is useful when equipment is only required occasionally. So if you don't need it all the time, it's better to lease it rather than buying it, right? A leasing agreement is generally easier for a new company to obtain, than other source of finance, long-term finance, right? This is because the asset remains the property of the leasing company. It does not become the property of the person enjoying the lease. Rather, it belongs to the leasing company. However, over a long period of time, leasing can be more expensive than actually buying the product, right? On the other hand, loans cannot be secured on the assets that are leased because the leased asset does not belong to you. It rather belongs to the leasing company. So you don't have the right to secure a loan on a leased asset, right? Then comes the hire purchase. Hire purchase is basically when the business actually obtains, like an equipment, mainly an equipment or machinery, right, and pays for it on a later date in set of installments. Business hires equipment for a period of time, and like fixed they pay on fixed regular installments. Once the payment have been finished, then the business actually owns that equipment. But remember, even if your last installment remains until that time, until clearing all of the installments, the equipment or the machine or whatever you're buying is not going to be in your name, right? So you are not legally the owner, right? It is different to leasing in that the business owns the equipment when it has finished the repayment. So remember, leasing is actually you're renting the equipment, and hire purchase is actually buying the equipment or buying the machine, right? And once the installments are being paid, you actually own the equipment or machine. Public sector organizations actually, like businesses, raise their money mainly from tax revenue from the government. Usually it is paid out in form of grants or subsidies. Fees are paid by the public or businesses, that's trade licenses and like things like that. So often they do have some public, such as transport, they do have their own source of revenue as well, right? So I think we're done for the chapter, almost done for the chapter, until we have a little more discussion to do with the criteria of choosing the sources of finance. So how do you choose which source of finance is more suitable for you? It is basically the amount of money required, the amount of money the business requires. how quickly money is needed. I mean, what is the mean? How long do you have, like to obtain the money, right? Do you have, to go? Do you have time, sufficient time to, like to convince the bank to go out with all the paperwork and obtain a bank loan, or you need like you have short time available for obtaining the finance. The cheapest option available. I mean, where the interest rate is actually very low, right? And the amount of risk involved in each of these like sessions, each of this kind of like the risk the reason you're investing, what is the amount of risk involved, right? So these are the criteria when you're actually like, these are the things you should consider when you're choosing the source of finance. I mean, where are you going to fund your money from if you're looking into the business, right? So I think that's the end of the chapter. And please do let me know if there is any problem, and if you have any questions regarding the chapter. Yeah, I'll be very glad to answer and reply you back whenever you need, right? Please stay in touch, and I will see you in the next session. Yep. So let's keep it up to here today. Thank you.